18 months. That's all the time you have before the largest wealth transfer in modern history erases everything you've built. I'm not talking about a correction. I'm not talking about a bear market. I'm talking about a systematic destruction of the traditional portfolio that will leave millions wondering where their retirement went. And the worst part? Your financial advisor won't see it coming because they're still reading from a playbook written in 1949. I've managed over $124 billion. I've studied 500 years of economic cycles. I've predicted every major crisis since 2008, not because I'm smarter than everyone else, but because I stopped listening to the lies that Wall Street sells to keep you comfortable while they position themselves for what's coming. And what's coming is brutal. It breaks. And when it breaks, only three types of assets survive. First, interest rates spike as borrowers compete for scarce capital. Second, asset prices collapse as leveraged positions unwind. Third, central banks print currency to prevent complete systemic failure. If you're holding bonds during phase one, you get destroyed. If you're holding stocks during phase two, you get destroyed. If you're holding cash during phase three, you get destroyed. The only assets that survive all three phases are the ones that exist outside the debt system entirely. But here's where it gets personal. I'm not talking about institutional investors or hedge funds. I'm talking about you, about the person watching this right now who has their entire net worth sitting in a retirement account structured exactly the way some 28-year-old advisor fresh out of college told them to structure it. We're going into deep water, and you want to be connected to people who know how to swim. Let me tell you about Michael, 42 years old, electrical engineer, solid career, married with 2 kids, paid off his house at 38, had $1,200,000 in his 401k, followed every rule, maxed out his contributions every year, never touched the principal, diversified across 12 different mutual funds. His advisor told him he was on track to retire at 55 with $3 million. Michael believed him. In 2007, Michael's portfolio was split exactly the way the models recommended. 65% in a target date fund heavy on large cap stocks, 30% in bond funds with an average duration of 7 years, 5% in cash. The allocation had a calculated efficient frontier. It had a Sharpe ratio of 1.4. It had every metric that makes financial advisors comfortable. It was a textbook portfolio. Then 2008 happened. By March of 2009, Michael's $1.2 million had become $670,000. He lost almost half his net worth in 16 months. But here's what nobody talks about. The loss wasn't the worst part. The worst part was what happened next. Michael's advisor told him to stay the course. The market always comes back, he said. You're young enough to weather this, he said. Don't sell at the bottom, he said. So Michael held, and technically his advisor was right. The S&P 500 did come back. By 2013, stocks had recovered, but Michael's portfolio didn't recover. You want to know why? He couldn't sleep. His wife started looking at their retirement calculators and realizing the numbers didn't work anymore. Here's what broke Michael. It wasn't the market volatility. It was the realization that he had done everything right according to the rules. And the rules were designed to fail him. He had saved. He had diversified. He had stayed disciplined. And he was still vulnerable to forces completely outside his control. Forces that his advisor either didn't understand or deliberately ignored. In 2020, Michael made the decision that millions of people make when they lose faith in the system. He sold everything at the March bottom and moved to cash. He was terrified of another collapse. He couldn't handle the volatility anymore. His portfolio was now psychological torture instead of financial security. From March to December of 2020, the market rallied 70%. Michael sat in cash, earning 0.1% interest, while inflation ran at 7%. He lost another $100,000 in purchasing power in 9 months. Today, Michael is 56 years old. He works night shifts as a cashier at a wholesale club because his retirement account isn't enough to live on. The $1.2 million he had in 2007 is now worth about $900,000 after inflation adjustment, and he needs at least $2.5 million to retire with the lifestyle he planned for. He won't make it. His story isn't unique. It's not even unusual. It's the default outcome for people who follow conventional financial advice during a debt supercycle transition. You know what the cruel irony is? Michael's advisor still has his job, still manages hundreds of millions of dollars, still recommends the same 60-40 allocation to new clients, still collects his 1.2% annual fee. The system didn't fail for the advisor, it failed for Michael. And it's about to fail for millions more just like him. I'm not telling you Michael's story to scare you. I'm telling it to you because it reveals the fundamental problem with modern portfolio theory. The entire framework assumes that markets are efficient, that diversification eliminates risk, that long-term holding periods smooth out volatility. These assumptions are true during the expansionary phase of the debt cycle. They are catastrophically false during the contraction phase, and we are entering the contraction phase right now. Michael's mistake wasn't lack of discipline, it was lack of understanding. He didn't know he was playing a game where the rules change mid-match. He didn't know that the 60-40 portfolio only works when both stocks and bonds can simultaneously provide positive real returns. He didn't know that when inflation exceeds 5%, bond returns turn negative. He didn't know that when corporate debt reaches record levels, stock buybacks become unsustainable. He didn't know that cash loses purchasing power at 7% annually when central banks are printing. Nobody told him these things because nobody wanted to complicate the sale. Here's what I need you to understand. Michael's advisor wasn't lying to him. He was repeating what he was taught. The entire financial advisory industry is built on models created in the 1950s and 60s when the United States was the undisputed economic superpower, when the dollar was backed by gold, when debt to GDP ratios were 30% instead of 130%. Those models are obsolete. They're worse than obsolete. They're dangerous. The traditional asset allocation gives you exposure to exactly two things: dollar-denominated debt and dollar-denominated equity. When the dollar is strong and debt is productive, that's fine. When the dollar is being systematically devalued and debt is being used to fund consumption instead of investment, you're not diversified. You're concentrated in the single worst place you could possibly be. Every asset in the world falls into one of three categories: assets that print, assets that produce, assets that protect. Right now, the Federal Reserve's balance sheet is $8 trillion. In the year 2000, it was $500 billion. They've increased the monetary base by 1,600% in 25 years. Every single dollar you hold in cash or bonds is being diluted by this printing. The yield on a 10-year treasury is 4.5%. Real inflation, not the manipulated CPI number, but the actual increase in cost of living, is running at 7 to 9%. You are losing 3 to 5% per year holding bonds. This isn't investment, it's slow-motion confiscation. But here's what your financial advisor will tell you. You need bonds for stability. You need cash for liquidity. You need dry powder for opportunities. It sounds reasonable. It's completely wrong. Stability in nominal terms is worthless when purchasing power is collapsing. Liquidity is worthless when there's nothing worth buying at reasonable prices. Dry powder is worthless when it takes 60% more powder to buy the same goods 2 years later. The only time you want exposure to assets that print is when monetary policy is tight and deflationary forces are stronger than inflationary ones. That describes the period from 1980 to 2020. It does not describe right now. Right now, central banks have one mandate: prevent debt defaults by any means necessary. That means printing, and printing means your cash and bonds are melting ice cubes. Assets that produce are claims on productive enterprise. Stocks, real estate, businesses, intellectual property. These assets generate cash flow from economic activity. When the economy is growing faster than debt, these assets appreciate in real terms. When debt is growing faster than the economy, these assets appreciate in nominal terms but decline in real terms. You make money on paper, you lose purchasing power in reality. This is the trap that caught Michael. His stock portfolio went up 30% from 2010 to 2020. He thought he was winning, but housing costs went up 60%, healthcare went up 55%, education went up 70%. His portfolio's purchasing power actually declined even as the nominal value increased. He was running on a treadmill set to 7% incline while thinking he was climbing a mountain. When interest rates rise, those valuations compress violently. You think you're diversified across 500 companies. You're actually concentrated in 7 stocks that represent 40% of the index, and are uniquely vulnerable to the exact scenario we're entering. Assets that protect are stores of value outside the monetary system. Gold, silver, Bitcoin, collectibles, land. These assets don't produce cash flow. They don't pay dividends. They don't generate quarterly earnings reports. They exist, and their existence is their value. When currencies are being debased, when trust in institutions is declining, when debt levels become unsustainable, these assets don't just hold value. They explode in value because they represent the only escape from a system that's destroying itself. Gold has been money for 5,000 years, not because of tradition, because of physics. You can't print gold. You can't create it from nothing. In a world where everything else is being actively destroyed, sitting there doing nothing is the winning strategy. These risks are visible. They feel scary, but they're manageable because they're based on fundamental value instead of policy promises. The M2 money supply increased by 40% in 2 years. 40%. If there's 40% more of something, each unit is worth 40% less. This isn't complicated. It's arithmetic. Your cash savings are being taxed at 7% annually through inflation that won't stop because it can't stop. The debt load requires inflation to be manageable. They're not going to stop printing. They're going to print more. Traditional bonds fail because they're long-duration bets on stable interest rates and low inflation. We have neither. When inflation is 7% and your bond yields 4%, you're losing 3% per year guaranteed. And that's assuming you hold to maturity. If you need to sell before maturity and rates have risen, you're taking a capital loss on top of the inflation loss. Bonds are supposed to be the safe part of your portfolio. They're actually the most dangerous part. Most stocks fail because they're priced for a world of 2% inflation, 3% growth, and unlimited central bank support. We're entering a world of 7% inflation, 1% growth, and central banks that have already fired all their bullets. The multiple compression will be brutal. A stock trading at 30 times earnings in a low-rate environment should trade at 15 times earnings in a high-rate environment. That's a 50% loss before the company reports a single bad quarter. The S&P 500 is currently valued at a total market cap of $45 trillion. That represents about 150% of U.S. GDP. The historical average is 75% of GDP. Mean reversion is not a theory. It's gravity. And we're currently floating 30,000 feet above where gravity says we should be. What goes up must come down. The only question is how fast and how far. Index funds fail because they're designed to track markets, not protect wealth. When the market goes down 40%, your index fund goes down 40%. There's no risk management. There's no tactical adjustment. There's no protection against systemic collapse. You're literally paying someone to guarantee that you'll lose exactly as much as everyone else. The three assets that survive are gold, commodity-producing equities, and cash-flowing real estate. Not gold stocks, physical gold, not commodity futures. Equity in companies that extract and produce physical commodities, not speculative real estate. Properties that generate rent in excess of debt service and operational costs. These three assets have survived every monetary collapse in recorded history. They'll survive this one too. Gold survives because it's nobody's liability. Every other financial asset is someone else's promise to pay. Bonds are promises. Stocks are promises. Cash is a promise. Gold is just gold. When promises are being broken systemically, the only thing that holds value is the thing that doesn't depend on promises. Central banks own 35,000 tons of gold. They're not stupid. They know what's coming. You should know what's coming too. Commodity-producing equities survive because they own physical resources that humanity needs regardless of monetary policy. We need energy. We need metals. We need agricultural products. These companies can raise prices when inflation rises because their products are inputs to everything else. They have pricing power. They generate cash flow in inflationary environments. They're rare among equities in that they actually benefit from the scenario that destroys most other stocks. Cash-flowing real estate survives because people need somewhere to live and businesses need somewhere to operate. But the key phrase is cash-flowing. Properties that are mortgaged at 80% loan-to-value are liabilities, not assets. Properties that are owned outright or mortgaged at 30% loan to value and generate rent that's 30% above expenses are assets. The difference between asset and liability is cash flow, not appreciation potential. If you're buying real estate hoping it goes up in price, you're speculating. If you're buying real estate because it pays you every month, you're investing. Here's the framework. 60% of your investable assets should be in inflation protection. That means gold and commodity producers. 40% should be split between income-generating real estate and a small amount of liquidity for tactical opportunities. This isn't the 60-40 portfolio. It could be farmland. It could be storage facilities or industrial warehouses. Your house doesn't burn down every year, but you still insure it. Currency collapse doesn't happen every year, but you still need protection. Step 3. Research commodity producers. You're looking for companies with 3 characteristics: low debt, high margins, and long reserve life. This is your opportunity fund. Step 6. Rebalance quarterly, not daily. You're going to watch your portfolio do crazy things. Gold will spike 15% in a month, then drop 10% the next month. Commodity stocks will be volatile. Real estate values will fluctuate. Ignore the noise. Check your allocation every 3 months. If anything is more than 5 percentage points away from target, rebalance it. Otherwise, do nothing. Time in the market beats timing the market, but only if you're in the right market. Step 7. Ignore the critics. And there will be critics, lots of them. They'll show you charts proving that the 60-40 portfolio has worked for 70 years. They'll show you efficient frontiers and sharp ratios. They'll tell you that gold is a barbarous relic. They'll tell you that commodities are too volatile. They'll tell you that you're going to miss the stock market recovery. Let them talk. They're looking backward. You're looking forward. The hardest part of implementing this strategy isn't the technical execution, it's the psychological warfare. You're going to watch your friends' portfolios go up while yours is flat or down for stretches. It crashes in dollar terms during periods of monetary stability. If gold drops from $2,000 to $1,500 per ounce, but the dollar has been inflated by 30%, you haven't lost wealth. You've preserved it. The whole point is to stop measuring success in nominal dollars and start measuring it in purchasing power. Trust that your advisor knows something that 500 years of history doesn't. Trust that this time is different. Go ahead and make that bet. Millions of people are making it right now. They can't all be wrong, right? Don't outsource the most important financial decisions of your life to someone reading from a script written 50 years ago. The wealth transfer is coming. It always comes at the end of debt supercycles. The only question is which side you'll be on. Will you be the person desperately trying to preserve what's left after your 60-40 portfolio gets cut in half? Or will you be the person positioned in the 3 assets that survive while everyone else panics? This decision is binary. There's no middle ground. You're either protecting your purchasing power or you're losing it. There's no neutral position when the monetary system is in the process of resetting. I've given you the framework. I've given you the allocation. I've given you the implementation steps. Everything you need is in this video. But information without action is just entertainment. You can watch this, nod along, think it makes sense, and then do nothing. That's what most people will do. They'll go back to checking their 60-40 portfolio and hoping everything works out. They'll wait for more confirmation. They'll wait for their advisor to validate what I'm saying. They'll wait until it's too late, and everyone else is trying to do the same thing at the same time. Or you can act this weekend. Open your brokerage account, look at your actual allocation, calculate how much you have in bonds and cash, start the process of liquidating those positions. Research gold dealers in your area, make a list of commodity producers to investigate. Look at real estate in markets you understand. Take the first step, not the whole journey, just the first step. That's all anyone can do. But that first step is everything because it's the step that separates people who prepare from people who hope. The community at Dalio mentality isn't about following me blindly. It's about connecting with people who understand that the rules have changed and are actively adapting to new rules. It's about sharing research on commodity producers. It's about discussing gold storage options. It's about helping each other navigate a transition that most financial professionals either don't understand or are incentivized to ignore. Subscribe not because you need me, but because you need them. The collective intelligence of people who see what's coming is worth more than any individual analysis. Hit that subscribe button. Join the conversation, share your own research, and learn from others. The next 18 months will define the next 18 years of your financial life. The decisions you make right now, the positions you take right now, the actions you implement right now, these will determine whether you retire comfortably or work until you physically can't anymore. This isn't fear-mongering. This isn't exaggeration. This is pattern recognition applied to current conditions. Every single indicator that preceded previous debt supercycle completions is flashing red right now. Debt to GDP, central bank balance sheets, real interest rates, fiscal deficits, all of them are at or beyond the levels that triggered transitions in the past. You can close this video, you can go back to your life, you can trust that someone else will figure it out. You can hope that your 60/40 portfolio will somehow defy 500 years of historical precedent. That's a choice. It's not a good choice, but it's a choice. Or you can decide that your financial security is too important to outsource to a system that's failing in real time. You can decide that protecting your family's purchasing power matters more than following conventional wisdom. You can decide to be uncomfortable now so you're not desperate later. I started this video by telling you that you have 18 months. Some of you probably thought that was dramatic. It's not. The Federal Reserve is already trapped. They can't raise rates without triggering a wave of corporate defaults. They can't lower rates without reigniting inflation. They're going to choose the path of least resistance, which is inflation. That means more printing, more debasement, more erosion of purchasing power. And once that process accelerates, the window to position yourself closes fast. Three assets will survive. Gold, because it's nobody's liability and can't be printed. Commodity producers, because they own physical resources that generate cash flow in inflationary environments. Cash flowing real estate, because people need shelter and businesses need space regardless of monetary policy. Everything else is a bet on stability returning. It's not returning. The system is too far gone. The debt is too large. The political will to make hard choices doesn't exist. What's coming is a managed decline masked as necessary policy flexibility. Your job isn't to predict exactly when the crisis hits. Your job is to position yourself so that when it hits, you're protected. You do that by owning assets that maintain purchasing power during currency debasement instead of assets that require currency stability to function. It's that simple. It's not complicated. It's just different from what you've been told. And different feels dangerous until you realize that conventional wisdom is what's actually dangerous. 2 years from now, you'll look back at this moment